Welcome to the Market Brief. I'm your host, and this is your fast, no-fluff look at what's moving markets right now. Let's get into it. Markets have been on a wild ride in recent weeks, whipsawed by geopolitical headlines out of the Middle East. The U.S. and Iran reached a framework agreement this past weekend to end the war in the Middle East, setting the stage for a reopening of the Strait of Hormuz, the critical choke point for about a fifth of global crude oil flows. The reaction on Wall Street was immediate. The Nasdaq jumped 3%, the S&P 500 surged 1.9%, and the Dow advanced 1.4% on the news, with technology, communication services, and consumer discretionary leading the way. Now let's talk about what got us here. The war is now in its fourth month, keeping the Strait of Hormuz blocked and shutting in much of the 20% of daily oil demand supplied by Persian Gulf nations, the largest ever energy supply shock. Iran's Supreme National Security Council confirmed a memorandum of understanding has been reached, with military operations on all fronts set to cease immediately. A signing ceremony is scheduled to take place in Switzerland this Friday. Crude oil futures slumped sharply on the news. North Sea Brent dropped 5.5% to around $80 a barrel, and U.S. West Texas Intermediate sank 5.1% to roughly $83. That's a major reversal from above $100 a barrel in April. For consumers, that should translate to some relief at the pump eventually. Now, inflation. Energy has been the story. The strength in the CPI has been largely coming from energy, with gasoline up roughly 8% on the month in May, alongside other idiosyncratic pressures, keeping the inflation backdrop sticky in the near term. On the wholesale side, there was a small silver lining. Core producer price inflation, which excludes the more volatile food and energy prices, grew less than forecast in May, rising 0.4%, slower than the 0.5% expected, and following a 0.7% gain in April. Core PPI held at 4.9% year over year, but came in well below the 5.4% consensus. Markets breathed a small sigh of relief on that print. So, what does the Federal Reserve do with all of this? The answer right now is wait and watch. Fed voter Kashkari has warned that a prolonged war could unanchor inflation expectations and trigger a series of rate increases. Analysts at CFRA noted the Fed is likely to dig in their heels with a rate-neutral regime and a higher rate bias until there is greater clarity on the Iran situation. With the peace deal now potentially on the table, oil prices pulling back and core PPI surprising to the downside, the Fed has a little more breathing room, but they are not out of the woods on inflation. Expect continued patience and data dependence out of the FOMC in the months ahead. Consumers are hanging in there, but just barely. The University of Michigan's preliminary consumer sentiment index rose to 48.9 in June from 44.8 in May, topping expectations of 46.0. One-year inflation expectations fell to 4.6% from 4.8%, and five-year expectations dropped to 3.4% from 3.9%. But the broader mood remains cautious. 55% of consumers are optimistic about their household finances over the next 12 months, but inflation remains the dominant concern, with more than 8 in 10 consumers ranking it among their top 3 financial worries. And concern about gas price increases showed the greatest rise of any category, jumping to 71% from just 37% in Q1 2026. So, what should investors be thinking about? A few things. 1. The Iran peace deal is a potential game changer for energy prices. If the Strait of Hormuz reopens, expect oil to continue falling, which would provide meaningful relief on headline inflation. Energy sector positions may face headwinds. 2. The Fed is stuck between a cooling economy and sticky energy-driven inflation. Rate cuts are not on the near-term horizon. Investors should not be counting on a pivot to come to the rescue anytime soon. 3. The PPI print was encouraging, suggesting upstream price pressures may be starting to ease. Watch the next CPI print closely. 4. Consumer confidence, while improving, remains fragile. Names tied to discretionary spending, retail, travel, dining could face pressure if household budgets stay squeezed. And 5. With markets having already rallied hard on peace deal optimism, the risk of a buy the rumor, sell the news moment is real. The deal still needs to be finalized, and the details between the US and Iran remain contested. That's your market brief for the week of June 17th. Stay informed, stay diversified, and we'll see you next time.